Hello, hi. My name is Jerry Miller. I'm the founder of Trendsignal, the trader education company. And this is part of our Monday Market Insight series. And today I'm going to be talking about interest rates or key interest rate decisions. The main interest rate decisions, the two very important ones I want to discuss this week are the US Federal Reserve. They have the rate setting committee is called the Federal Open Market Committee. And then we have the Bank of England. They have their own rate setting committee called the Monetary Policy Committee, and that meets on Thursday and concludes at midday. Uh, Central banks are charged with managing price stability. In fact, the US Federal Reserve has got two mandates, and the other one is to foster full employment, which is the reason why there is so much interest in the US regarding the non-farm employment or employment data, which coincidentally is this week as well. So it's a very, very important week for the markets. Why is it even more important this week? Well, both central banks are really playing catch up. They've got behind the curve. More so in the US. The UK's Bank of England actually has already started raising rates. We're currently at 0.75%. We are expecting the central banks to um, uh, make changes to their interest rates. In the US, we're expecting a rise of 0.5%. Let me just show you a chart here. This is a chart from the Chicago Mercantile Exchange, where they trade forward contracts on the Federal Reserve. So it basically is telling us what the market thinks rates will be on any given day here. And these dates here that I'm running across with my cursor are the dates of the next monetary policy meetings conducted by the US Federal Reserve. And the next one, 4th of May, that is Wednesday, 4th of May, we're expecting interest rates to rise from 25 to 50 basis points, so that's quarter to 0.5%, and we're expecting the Federal Reserve to raise them to 3/4 to 1%, which is a big jump of 0.5%. Why are they raising rates by 0.5%? That's because they decided back in June, July, August last year that the uh, increase in inflation was transitory and was down to the end of the pandemic and the supply chain blockages that we know about that have happened globally. Well, we've had that, and the pandemic in China has persisted with their zero policy on COVID, and there have been further rolling lockdowns in key Chinese cities, which is resulting in further supply blockages, added to the fact that we've obviously got the war in Ukraine and the massive spike in energy prices, natural gas, crude oil, and the effects on base metals as well. On top of that, you've got a big rally in the dollar because the market is expecting all these big rate rises in the US. I've just clicked on December the 14th, which is the last monetary policy meeting in the US, and the market has a prediction that rates are going to be close to 3 to 3.25%. As I say, they're currently at quarter to 0.5%. So we're talking about 2.75% further raise in rates. So over the year, which is hugely significant. And that's already sort of baked into the markets, really. Now, those future predictions will ebb and flow as the course of the year progresses. But for the time being, with inflation at a 40-year high in the US, the Federal Reserve has a lot of catching up to do. Now, we also have interest rate decision in the UK as well. In the UK, we've already pushed rates up to 0.75%, so we've had two rate rises already. And in the next policy meeting, that's on Thursday, the 4th of May, we're expecting another quarter point rise. And that'll take our interest rates up to 1%, which actually will be the highest they've been since 2009. So it is significant, and we are pretty much expecting that to happen. Um, but the important thing is, how is this going to affect the markets? That's what we all want to know. Firstly, US, these expectations are baked into the market. So if the market does not, if the Federal Reserve do not raise rates by 0.5%, so they only raise them by 0.25%, you will see a significant fall in the US dollar, which is priced in these rate rises, and you'll probably see quite a positive reaction in the equity markets. The bond markets will be mixed. There's been significant moves in the bond markets. The yield on the 10-year Treasury, that's the US 10-year sovereign bond, before the start of this year, at the end of last year, the yield was around 1.5%. Well, it nudged 3%. So there's been a significant reaction in anticipation of what the Federal Reserve is going to do. In the UK, same thing really. If the Monetary Policy Committee do not raise rates, you will see a significant fall in sterling, possibly below 120 to the dollar, currently trading around 124 and a half. The reason being, interest rate expectations affect where people put their money, and if rates aren't going to be going up as much as expected in the UK, people take their money out and put it elsewhere when they can get a better return. Um, so there are commentators who are saying that we're probably already in an recession here in the UK. That's characterized by two negative GDP um, numbers. But actually, it's likely that we could enter a recession, and there are some commentators suggesting that we shouldn't be raising rates at all until we've seen the effects over the next 2 or 3 months. As I've said at the beginning of this piece, it's a delicate tightrope walking exercise, as Governor Bailey of the central bank, the Bank of England, said. They're damned if they do, damned if they don't. Their job is to maintain price stability, and they've got a lot of catching up to do. Let's see what happens. But half point rise in US rates, quarter point rise in UK rates. That's it. Thanks for watching.